Hey, good morning, everyone. Good morning.
Good morning, Professor.
Hey, good morning, Devin. Hey, how's everybody else? One person greeted back. Only one person. Where's everybody else? Huh? All righty. Good
Good morning,
morning.
Professor.
Good
Hello,
morning,
Professor.
Irina. Good morning, Shabir. Uh, okay, let's see. I see. Good morning, Dimitri. I see. Let's see. 10 people here, and in the forum, I see 13. So a couple of more people should join the collaborate session. And just to remind you, everyone is aware that midterm one is already on, right? Hmm?
Yes,
The
Professor.
announcement went,
Yes.
the announcement went out already, last week, right? Midterm one instruction, and you were instructed to email me to confirm, and I only got about 5-6 emails. So everyone is aware. If ever, it actually started yesterday and due tomorrow, right? Any questions? So everyone is aware, right? I hope, I don't want to hear later, Professor, I never knew, I didn't know. It is your responsibility to keep up with it's your responsibility to keep abreast of what's going on in the class, right? This was posted already Saturday, March 5th. That was last Saturday, right? So the email went out also at the same time. Okay. All right. I hope everyone is clear about that, and hope nobody will come back later, saying, Professor, I didn't know, right? Uh, okay, so let's so we need to continue from where we left off last time. So what we basically and we got a lot to do. Um, so we talked about the present value of growth opportunity and how it is related to the plowback ratio and growth rate, right? And I also want to remind you that the main lecture, by main lecture, this topic 2 is already done. You should have already studied all of this. Look, they already grayed out. All these videos are already grayed out. There are like 25 videos, actually 20 videos, because we started from part 7, right? Because part 1 through 6 is Finance 100 material. Now, by the main lecture, you must be done. I mean, collaborate session is just about somewhere here now. But as I said, collaborate session is only a review session. It's just reflection. So you must go by the main lecture to stay ahead of the game. It's always, it's critical that you stay ahead of the game. And it's not really staying ahead of the game. You're simply, just staying on schedule. You're just, staying on schedule, right? And by that, right, by the main lecture, you should be all caught up. We're into topic 3, and you should be all caught up to this part, to all the way to immunization, duration and immunization, This is what you should study. This week, actually, this coming. This is for how long? Some of these are. This is actually on 9th through 15th, right? Today is 12th, so you have 3 days left on that, right? Even, Bondfolio Management 1-2, Stan.
Professor, hi, good morning.
Yeah.
But yeah, just a quick note is that you haven't explained a lot from. I know you said that we have to see the lectures, and what we do in class is just you go to the lectures, but um, you're not going through much of the lectures on your class.
Well,
You're
that's
being,
why.
you're being
That's why.
focusing more on discussing politics and saying, "Hey, I don't like Republicans and Democratic politicians," but not going through lectures. So.
No, that was that was inevitable. I mean that's why that's why in the collaborate session sometimes I digress a little, um, but that wasn't more than like 15 minutes. I actually checked last time how much of the class time but that was related. It's totally related because um, it's not that I don't want to be political about this, but um,
Yeah, and I'm not saying that you should not, but I guess when you said about stock valuation and then you start like um, when
all
we go
has to
through
do with.
macroeconomics from the macro to the technical valuations of stock, like politics is just one of the things that you should evaluate when you evaluate valuations of a stock
No,
or
no,
of
no,
a
no,
bond
no.
or something
Well,
like that.
yeah, it's an extra variable, but it's not the main variable. And again, the reason I brought it up was probably because um, not for the politics per se, but because um, uh, the policies that the especially about the tax policies, that has a lot to do with uh, actually with the growth, and so it had to be touched on. Not it wasn't for expressing my own political opinion. Again, um, I don't care. I mean, if it is, I don't care if it is Republican or Democrat. Whoever is doing something right for the economy, that should be the right policy. But again, if you go over that last week's recording, um, it wasn't more than 15 minutes, and then of course 15 minutes is still a big chunk of time, but it was related. Uh, it was inevitable. It had to be discussed. Um, because we were talking about where the economy is standing and um, how uh, the view on uh, big government or small government, um, what kind of policy should be implemented, um, uh, and when the economy is in recession or when the economy is overheated, and all that is related to why and why is the economy standing at this and where the economy is standing and whether the economy is good or strong or not. currently, probably the discussion was rather that about, some people have false impression that the economy is bad, which are mostly, Republican leaning people with, Republican leaning, um, tendency. But, I was saying, in fact, the economy was strong, not bad. Okay, but economy can, at this point, with the war and the oil price and inflation, uh, economy can turn into a stagflation. But when think about it, the whole point I was making was that the jobs are plentiful and job openings. There are more job openings than the people looking for people willing to work, and the wages are growing. Wages are growing, and that certainly is not a bad economy. And only because of the inflation, um, if some people are saying the economy is bad, then that's because they have no formal education in economics. Because the whole point is, um, even though the inflation is high, but as long as the growth rate, this is just a very basic macroeconomics sense. If the growth rate is greater than inflation, right? If you're in, then that's not a bad economy. That's a strong economy. That's a thriving economy. And uh, but unfortunately, we are currently uh, like this, but we were like this, and uh, so it was inevitable to touch on that again. That's why the in the collaborate session, we cannot cover everything, because if we cover everything, then one semester is only 14 weeks, 14 sessions. We have already had 5 sessions, right? And if I talk about everything, if I go over everything, it's gonna we can't do it in 14 weeks. We will need 30 weeks at least. So that's why I gave you my YouTube channel, where you can find all of my lectures there, right? And then it doesn't have to be limited to 3 hours. Don't think don't think this 3 hour uh, session is everything you need to do. It's, I've been telling you, this 3 hour session is just the review and reflection, and you will um, throughout the week, right? You can study. You can watch the main lecture videos. If it is already passed, then you can find them on the YouTube, and then you can watch it. Taking as much time as you need. 12 hours. I mean, spread over 1 week, right? So that's basically the understanding we had, already, from the beginning. Okay, I would like to go over every example, everything, but we simply don't have time. Okay, um, so so next we need to the plowback ratio and growth rate is an important element in the golden growth model. So we talked about that a little, but basically, we were, talking about the golden growth model, and golden growth model is the second model, and the third model is the variable growth model. Okay, if you remember, there are four models, right? Constant dividend model, zero growth model, or perpetuity model, right? Second model is, a constant growth model, or golden growth model. Third model, variable growth model. Fourth, free cash flow model. So now variable growth model it's based on the product life cycle. I mean, in other words, to put it simply, no company grows at a constant rate. I mean, there are many phases of growth rates. Some early on, a typical, I don't know if okay, I didn't put product life cycle here. So I think the product life cycle was already explained in the Finance 100. So let me just quickly, and I believe review of Finance 100, review of Finance 100 is here. So if you download it, okay. There is, I put, the slide will be too big if I put everything on. So I put it here. Where is it? Okay, this is not right. But in the main lecture videos, the product life cycle is well explained. Okay, so please, the product life cycle is explained in the video number in one of these videos, right? 10 through 12, one of these videos. So I'm not going to go over that again because it's going to take also a lot of time. But let me just quickly show you. Okay. Yeah, here, I'm not, basically all products and industries go through the life cycle. Of course, the stylized theory, a stylized pattern is that the products go into decline phase. But actually, it doesn't have to go into decline phase. Eventually it will go into decline phase, but it can be always reinvented. But the point is, look, the growth rates show at least four different phases. First, it grows at an exponential rate. It grows at a fast rate. It goes into the steady growth rate, constant growth rate, and the growth rate slows down. So high growth rate, low growth rate. When the slope is steeper, if the slope is steeper, that's high growth rate, fast growth rate. When the slope is flatter, lower growth rate, right? And when it's at apex, right, on the growth rate plateaus. That means growth rate is 0, and then when the slope is negative, then it's growth rate is declining, or negative. Growth rate is negative. Of course, we're not interested in the company that has negative growth rate. There's no one who would invest in a company that is that shows negative growth, and there is no reason to invest in a company that has 0 growth rate, right? So the only relevant two stages are fast growth and steady growth, fast growth and slow growth, right? Now, when as I said, when the company is in a fast growth phase, of course, the slope of the revenue would be steep. And when it is in a relatively steady growth stage, right, the slope will get flatter, right? Flatter. And one thing, two different patterns, this one is called, exponential growth. When what you can see is the slope is getting steeper and steeper, right? But, past certain point, the slope is getting flatter and flatter. When slope is getting steeper and steeper, that means growth rate is accelerating. I mean, the company is growing at a at a faster rate. The growth rate gets bigger and bigger. The growth rate gets higher and higher. And that's the exponential growth or explosive growth, which is completely different from relatively constant growth. This is growth rate itself is constant. Think about it. It's steeper. I mean, it's not getting steeper. It's steep, but that doesn't mean it's getting. It's just steep. It's not getting steeper, right? So all of this is explained in the main lecture, right? What is the difference between exponential growth and just constant growth? So first, so let's take a look at this example. In variable growth model, right? Actually, we're looking at two different, not two different, but one way. There are two ways. It's either called variable growth model or a multi-stage model. But actually, a multi-stage model can be only in one of the two-stage growth or three-stage growth. So two-stage growth model, example of two-stage growth model is explained in the this example. So suppose Warren Industries, right? A rapidly growing boat manufacturer paid $1.50 dividend per share. Okay, the firm's financial manager. So most recent dividend was $1.50, and that's at the end of 2012. Okay, so time zero in this example. 2012, right? So also that means a dividend at time zero is $1.50. Okay, so and then the firm's financial manager expects that these dividends will increase at a 10% annual rate, G1 growth rate. It's me who put G1 there. I mean, in the original problem, it just said 10% annual growth rate. But just to make it clear that we have two different growth rates, I made distinction by calling it G1. The dividend is going to grow at 10% over the next 3 years. At the end of those 3 years, so at the end of 2015, the firm's mature product line is expected to result in a slowing of the dividend growth rate to 5% per year. So we have a second growth rate, G2, for the foreseeable future. Firm's required return is 15%. So, I closed it too soon, but let me open it again. Okay. So think about it. So for the first 3 years, right, it's going to grow at like 10%. So I don't know if you can see where the where my cursor is. It's a picture, so but you can tell in almost when the slope is steeper, right? When the slope is steeper, right here, right? When the slope is steeper, that's when the growth rate is 10% at high growth rate. Clearly, when so for the first 3 years, right? That's the range where the slope is steeper, right? And when the slope is flatter, then that's after 2015. So so I summarized it here in the in this Excel file, which is the file that you should have downloaded already. If you have downloaded this file, right? That's this file, right? You will need also to download these too, and I told you to download those files too. So this is the scenario, right? I don't know when I posted it if it was filled in already or whether I filled in. But if it is already filled in, uh, please delete. Please delete. All the highlighted cells. Okay. Now first, so for the first 3 years, right, it's going to grow at 10%. So we can forecast what dividends we're going to get, right, for the first 3 years, right? So we know in 2013 it's going to be, at, $1.50 times 1 plus growth rate, and I'm going to lock it, right? Lock F4, right? Because the reason I'm locking it is because I'm going to drag it down so that I can generate all the forecast in a single shot. And then we don't need to raise it to 1, because it's not going to make any difference, but we need to do it here because that way we can have a uniform solution, right, or uniform procedure um, for rows 28 through 30. This way we can easily also here see 28 must be also locked so that it's not going to change when I drag it down. But this way, if I do it this way, then I can simply drag it down, and for year 2, the exponent will automatically adjust to this. Year 3, exponent will automatically adjust to that. That way, I generate forecast for the next 3 years. Okay, and then because valuation is basically about present value. So we need to simply, find the present value of all these, right? So C28, and then 1 plus. This is the required return. So 15% is the required return for this company. So, and then we lock it. And because I'm going to drag it down, right? Also raise to the years digits. This way we can find all the present value, right? And we're going to find sum of all of these. And that's the present value of all the dividends, right? In the next 3 years. And then next, the finance manager forecasted that it's going to grow after 2015. In other words, from 2016, it's going to grow at 5%, right? For the foreseeable future. This is just the way it is worded. Okay. For the foreseeable future. When foreseeable future means, it's another way it is worded is indefinitely. Okay, but what does that mean? Then it goes from that point on, it goes into a constant growth phase. Okay, constant growth phase. So if a company goes into a constant growth phase, what does that mean? That means, use the golden growth model, right? Use the golden growth model. So from here, we're going to generate, right? What's going to be the dividend in 2016? We know because golden growth model basically, uses dividend at time t plus 1, right? That's golden growth model, dividend at time t plus 1. We need dividend at time t plus 1. So dividend at time t plus 1, which is 2016, that's time t plus 1, is 5% more than this. So we'll multiply that by 1 plus 5%. Okay? And so it's going to be $2.10. And then we can find the price of the stock price, right? Price of the stock at the end of 2015, right? Think about it. 2016 is time t plus 1, right? So the price of the stock at time t, right, which is the price at the end of 2015, will have to be, right, following, golden growth model, right? Dividend 2016 over R minus G. So that divided by our R is here, over here. Okay. All right. So we found the stock price at the end of 2015, but of course, our time zero is 2012. We need to know the stock price at 2012, at the end of 2012, right? So then we will need to find the present value of this, present value of, right, end of 2015 stock price, so that it will be, the present value. In other words, end of 2012 stock price. Then all we need to do is we discount it by R raised to 3, right? To the third power. So that's the price. That's the present value of 2015 stock price, right? But then think about it. That's only, but that's only the present value of end of 2015 stock price. But we also have the present value of all of these dividends for the next 3 years, right? So we need to combine these two, right? Because this is the present value of the future cash flow, right? For the first 3 years, and during which the growth rate was 10%, right? Fast growth rate. And then the present value of the 2015 stock price, that is based on the assumption that it's going to grow at 5%. So we need to combine those two, right? So here we'll have this plus this, and then we get 17.90, 17.90. That's the rational price or the intrinsic value of the stock as of end of 2012. Okay. Now again, you can tell, oh, if there's a meaning in the color coding, right? um, the violet, this violet, well, I don't know whether it's what should I call it, lavender, right? The It's lavender. Lavender color is present value, right? This drab or olive, that's like uh, the, future values, right? Expected future values. This is the solution, right? So this is two-stage model. And why? Because we have only two stages in growth, which is very artificial. I mean, suddenly it grows. I mean, it's not totally it's not totally impossible, but think about it. It doesn't. It's almost assuming that the growth rate. It's almost like assuming that the growth rate is like let's move. It's almost like uh, the pattern of the revenue is like this, right? With a kink here, right? Nothing moves in this pattern, right? The reality isn't like this. I mean, reality would be something like reality will be something like this, but we still want to uh, we cannot exactly uh, uh, we cannot exactly track it like this way, because uh, it's not impossible, but then it lowers the efficiency, right? So we want to smooth it out. But if we smooth it out, we want to smooth it out like this, right? Not like this. So the reality is more like this, right? You understand? The reality is more like so that's why there is three-stage model. In three-stage model, then there is like fast growth, and then uh, gradually dropping, gradually decreasing phase, and then uh, relatively constant, or the range where we can assume uh, golden growth, right? Okay. Now that example is actually that example is explained in the main lecture videos, and let me show you. Actually, in um, spreadsheet 13.2, right? This exercise is really, I'm sorry, that is, I'm talking about, 13-1. Spreadsheet 13-1 is the three-stage model, right? Three-stage. You see, we have fast growth, right? I mean, dividend is already forecasted, but this is sort of like fast growth stage, right? The growth rate wasn't given because they provided already the data. they provided data already, right here. They provided data. So this is the fast growth. And then they go into a relatively smoothly decaying, I should say, smoothly decaying growth. And then finally, constant growth, right? So we don't, please, watch the main lecture video where I explain this. We don't have time to go over this during the collaborate session, right? So then that will okay, product life cycle and multi-stage growth. So, sorry, give me a. Hello? Oh, yeah. Oh, sorry about that. Somebody's coming to fix something, fix my window. So I had to get that call. So the next model is free cash flow model. And the free cash flow model is the model that is used when there is no dividend. And you understand that not all the companies pay dividends. Not all the companies pay dividends. So if, as I said before, dividend discount model breaks down when there's no dividend, right? And of course, you should know that the dividends are not an obligation. Dividend is an option. Company may or may not pay dividends. And also the fast-growing companies don't pay any dividends, right? Because they need to plow back everything. They need to plow back everything into growth, so they don't pay out dividends. And if they don't pay out dividends, then how do you value those companies, right? So that's why there is that's why we have free cash flow model, right? So that was okay. And actually, free cash flow model is pretty much like a variable growth model, except the fact that instead of dividend, because there's no dividend, we have to use free cash flow. But what is free cash flow then? So free cash flow is defined as operating cash flow minus investment in operating capital. Okay. So so this is something we did also in Finance 100 and also in Finance 230, especially the defining what free cash flow is. So basically free cash flow is what is the it's what is available, right, to the after. Think about it in a simple, concise way. It can be defined as uh, the cash flow that's left over after subtracting expenses for maintaining the capital, right? In other words, after subtracting the capital expense or capex. Now, so think about it. Uh, First of all, operating cash flow is cash flow generated from the operating activity. And you understand what operating activity is. Operating activity is all the companies, all the businesses engaged in, all the companies engaged in three types of activities, right? Uh, so I believe I already talked about that somewhere here. I didn't. All the companies engage in one, operating activity, right? Two, investing activity. Three, uh, financing activity. And then operating activity is basically, the income statement activity. In other words, uh, in income statement, right? Um, uh, we don't need to go over this again. Basically, from here to here, right? Uh, from income to operating, those steps, every step from income to operating income or operating profit, that's the operating activity. What's going on from income through operating profit, that's operating activity, right? So obviously, the result of the operating activity is the final result is net income, right? Net income. But it's not all. It's a little different from operating income or operating profit is EBIT, right? And but it's not entirely all cash. Okay. Again, tax is something. Tax is tax is something you cannot touch, right? This is not. No matter what, if you lay a finger on the tax, right? Then you're gonna. Uh, Excuse me. Give me a second. Just repair an eyes. All righty. So I guess it's 10:27, so it's pretty good. It's pretty much the time to take a break, and I will have to put you on a break for um, like 10 minutes because this gentleman is here. So I think it's coincidentally a very good time to take a break. So let me put you on a break for 10. Okay, I will reconvene in 10 minutes. Okay. All righty.
You should give him a glass of water.
Yeah, thank you for that. I should also have something to soothe my throat. Okay. All right, we're back. We're back. So, where was I? So, operating. We were talking about the operating cash flow, right? So basically, um, I showed you um, what operating activity is, right? I mean, instead of explaining it verbally, right? Um, right? From income, right? So it's basically all the activities, right? All the activities involved in generating income and paying out expenses, right? And arriving at operating profit or EBIT, right? Now, then what is operating cash flow? Um, and how is it different from EBIT? I mean, EBIT looks like, the result of the operation. So wouldn't it be operating cash flow? No. Um, so where did again, I don't think I put operating cash flow somewhere here, but if I did, I put it here? Maybe not. Okay, so I don't see it here. I'll have to go back to the slide. Now, EBIT is the operating income or operating profit, but that's not operating cash flow because first of all, you'll have to get rid of the taxes, right? You'll have to take out the taxes because that's not the cash flow available to you. But then you will need to add in the depreciation. Why? Because depreciation is what they call non-cash. Maybe in accounting class you've heard this over and over. Depreciation is non-cash outlay. But what does that exactly mean? Non-cash outlay means, it's a hollow shell. It's an expense, but it's a hollow shell. Expense that you didn't really expense that you didn't really incur that year, right? So this takes a lot of time to go over that again. But if you have followed, if you have followed me every step, 100 to 30 and, to 300, this has been discussed more intensively in 230, Finance 230. So it shouldn't be, you should know. It doesn't need to be explained again. But the point is, depreciation is an artificial way of spreading, dispersing depreciation is an artificial way of dispersing the expenses over a number of years, right? For example, if you spent 50K in year one, so that means at time zero, right? If you spent 50K, normally you would write off, normally you would like to write off that 50K. I mean, this 50K is the business expense, especially, in acquiring physical capital like production equipment. And if you did this at time zero, right? Of course, you acquire the production equipment at time zero and pay 50K at time zero. So this is an expense incurred in time zero, and you would normally want to write it off. You want to write it off in year one. But they don't want you to do it that way. They want, and they mean, they means here. The pronoun they means here. Um, um, the IRS. IRS doesn't want you to write it off in year one. They want you to spread it over like 5 years. So then, in year 1, 2, 3, 4, 5, 10K, 10K, right? All 10K. You spread it over 5 years. Now, of course, in year 1, you are under and in year 1, you're going to write off this as expense. So you're relatively underdoing it, right? But then from year 2 through year 5, these are expenses that wasn't actually incurred, right? These are expenses that weren't actually incurred during those years. But you make it, because you are depreciating it over 5 years, it makes it look your EBIT. It will make your EBIT look smaller. In other words, because there's additional expense that are hollow. These are hollow, right? That means cash preserved, right? Cash preserved, right? Cash preserved. Because in those years, right? Year 2 through 5, this much cash has been preserved. This much cash was saved, right? And then, but since they are recorded in the income statement as the expense, then that reduces the EBIT by as much each year. It reduces EBIT by 10K, right? If EBIT is reduced by 10K, accordingly, EBT, taxable income, is also reduced by 10K. So then if your taxable income is smaller, then you pay smaller taxes. That way you have tax shield. It gives you a legitimate, legal tax shield, right? But then because it is hollow and because it is cash preserved, it gives you more, cash availability. That's why you add back this in. Okay? That's why you add back, depreciation in. So that's operating cash flow. But then think about it. This is the cash flow generated from operating activity. And if there is any capital expense, where does it have to come from? That capital expense must come from the operating cash flow. And the capital expense is basically, change in gross fixed asset and change in net working capital. In other words, change in gross fixed asset means what? If you have to, equipment, plant and equipment. If you need to increase the size of the plant. In other words, if you need to increase the production, your production capacity, you will need to acquire more plant and equipment. I mean, even if you don't want to do that, even if you don't want to expand, because of the depreciation. Depreciation doesn't only mean numerical downgrading, but think about it. Depreciation is also automatic because what does depreciation mean in the first place? Is the depreciation of the value of your fixed assets, right? And the depreciation of the value of your fixed assets is due to wear and tear. All the machines, right? Wear and tear with usage. There's nothing that stays in mint condition still, If still stays in mint condition, you've never used that asset. You've never used that equipment. But with every use, right, the equipment will wear and tear. With wear and tear, not the value has to go down. The value has to go down. Make sense? And not only the value, but also the production capacity goes down. When your machine wears and tears, obviously it's not going to be as productive as when it was new. Right? Makes sense? So that kind of, and when the production capacity of your plant and equipment goes down, no management will just, watch it doing nothing, right? They won't just watch their production capacity go down with their hands down. What do? I mean, they will at least try to replenish what's been worn out. Make sense? Because the lower the capacity, the lowered capacity means lowered output. Lowered output means, lowered revenue, lowered sale, lowered revenue. Lowered sale and lowered revenue also means, losing market share, right? Losing market share. So you don't want to, no management will just, watch it, hands down. So what do? They will have to replenish at least replenish the worn out portion of the equipment, or even expand. So there's a change in gross fixed asset and change in net working capital. They must all come from the operating cash flow. And so that's called, investment in operating capital, right? So that's free cash flow. I mean, that's free cash flow. Okay. And and this definition is usually free cash flow to the firm. Free cash flow to the firm. This is exactly the definition of free cash flow to the firm. And then there is also free cash flow to the equity holders. Free cash flow. So I'm going to get to that shortly. Now, here's an example of free cash flow model. So in this example, right, we need to also understand the concept of weighted average cost of capital. If you have taken FNB 230 already, you know what weighted average cost of capital is. So basically, value of the firm is all the free cash flows discounted to present. So VC stands for value of the company, right? Value of the company is the sum of all the present values of the free cash flows. And here, this discount rate, the notation is RA. Why RA? It's the average, that A stands for average required return, also called weighted average cost of capital. And weighted average cost of capital, why do we need weighted average cost of capital? And what is weighted average cost of capital? Weighted average cost of capital is weight of equity times cost of equity plus weight of debt times cost of debt. Okay, why? Now think about it. Because free cash flow is it's like a fruit. Okay. Any, free cash flow is like suppose, you are a farmer and you have an apple tree, right? You are tending to an apple tree. Okay. And obviously the apple tree will give you apples. In the fall, right? In the harvest season, the apple tree will give you apples. Any fruit tree will give you fruit, right? That goes without saying. So this harvest of apples is like free cash flow. Okay. Now the tree is your total assets. The tree is your total assets. Isn't that right? But what is total assets? Total assets is debt plus equity. Isn't that right? Free cash flow is the fruit of your total assets, workings of your total assets, right? But your total assets, debt and equity, is in some combination, and so it's not just one debt and one equity. You understand? They have some proportion. I mean, that's what capital structure means. You all understand the capital structure. You all, I don't know if it was ever mentioned, if it has been mentioned, but I'm sure, if not in this class, but this is something you should,
This is a FNB 100, right?
right from FNB 100, also from FNB 200, right? We did more about capital structure in FNB 200. And so let's say equity is 70%, debt is 30%. That's capital structure. Then think about it. That's the weight of the each capital component, right? This is weight of debt, weight of equity. So if you think about it, this fruit is 30% thanks to debt and 70% thanks to equity. Make sense? So when you are discounting free cash flow, right, you cannot discount it by only R. You cannot discount it only by cost of equity, right? Because so far it's been old dividend discount model, right? So all the value of the stock, right? All the values that was a result of discounting dividend by KE, cost of equity, right? I mean, in Gordon growth model, right? Dividend at time t plus 1, right? And if it is not Gordon growth model, if it is constant growth model, it's just dividend over K, right? Yeah. In other words, this can be either positive or 0, right? And this can be also nothing, right? No time subscript needed if it is constant dividend model. Because it was all dividend, you could discount it by cost of equity. But free cash flow is not only the fruit of only equity, but it's the fruit of 30% thanks to debt. So then the discount rate shouldn't be only cost of equity. It should be also cost of debt as well. So it has to be the weighted average it must be the weighted average of the two. It must be the weighted average of the, that's called weighted average cost of capital, okay? Hence, so you discounted with, weighted average cost of capital, And at the end, you will need to the price of this, all these, I mean, the present value. This present value is, the present value at after uh, after the company goes into a steady state. Okay, the present value. So then it's golden model, right? And then you need to find the present value as of time zero, right? This is the present value of all the future cash flows after the company goes into a steady state. So then once that way we can find the full value of the company. And then when because the value of the company is the value of common stock, that's common stock, and value of debt and value of preferred stock. And so we know stock consists of, stock breaks into a common stock and preferred stock, right? And of course, if the company doesn't have any preferred stock, then there's no problem. But if the company has preferred stock, we'll need to also count it in. So value of the company is value of common stock. A value of the company is the value of the common stock, value of debt, value of preferred stock. And what we are interested in is only the value of the common stock, right? Value of the common stock. And value of the common stock is the value of the company minus value of debt and value of preferred stock. So this formula only, free cash flow formula only gives us value of the company. So we need separate information about the value of debt and value of preferred stock. And if that information is given, good. If it is not given, then we need to do the bond valuation, right? We know how to value the bond. And preferred stock is perpetuity. Preferred stock is perpetuity. We can also value this by using constant dividend model. Okay, and if we do that and we subtract that, then we find the value of the common stock. But this is, again, value of the common stock is this is all of these are aggregate dollar values, aggregate, right? So if you find value of the common stock, it's aggregate. So if you, when we say stock price, it means per share, price per share. So what we need to do is then we'll need to divide this by number of shares outstanding. So that example here, I'm gonna, I think I barely have time for that. So here, that example is done here. Okay, so so again, I did all. Okay. Oops, why? Okay, so I need to also turn it into something like, lavender, so because it's present value. So doesn't it look pretty much like, this, the variable growth model? Yes, it is. So I told you, in essence, it's pretty much like variable growth model. So here, let's take a look at this example. This Warren Industries, that was okay. Dewhurst Inc. The free cash flow forecast is like this for the next 5 years. 1, 2, 3, 4, 5 years. And the growth rate beyond 2017 to infinity, right, for the foreseeable future, or indefinitely, growth rate goes into the steady state of 3%. And weighted average cost of capital is 9%. So this is easy example. They already gave you everything. If it is a more complex example, then you will need to calculate actually weighted average cost of capital. You will need to look into the balance sheet and find the capital structure, and then but they gave you also this, and market value of debt they gave you, market value of preferred stock they gave you, number of shares outstanding, common stocks outstanding 300,000. So all you need to do is just again, our time zero is 2012, right? We all know. That means our time zero is, right? So we need to first find the present value. So we need to first find the present values, all of that. Okay, and nothing difficult, just discount it, right, by weighted average cost of capital, raise it to the years digits, and just drag it down. And then, but here, why do I have this column F? I mean, if you think about it, it's just simply, duplicating. It looks like I'm just duplicating here. No, there's a good reason why. In the year 5, I have a different number here. Why do I have a different number? I actually added this number here. And what is this number? This number is the end of 2017 value of the so this shouldn't be, I'm sorry, it shouldn't be that color, it should be just, okay, oops, end of 2017 value of all the future cash flows in constant growth phase. Okay, constant growth phase. So, and finding that isn't difficult. It's just Gordon growth model. You just need, one period forecast of the free cash flow, which can be done, because, and then divided by R minus G. So this is, simply forecasted this way, right? And then 2017 value is found, right? And then because that's 2007 value, I added that to forecasted or projected cash flow of 2017. And then all you need to do is that I found the present value of all of that. This is the sum of all those present values, right? This is the sum of all those present values. I have to put that in highlight. And then this simply needs to be, this is the, and then this is, since this is the present value, 2012 value of, right, 2012 value of the firm, right, We got that. And then they very kindly gave us already value of debt, value of preferred stock. So to find value of the common stock, all you need to do is subtract sum of these two from value of the company, right? And then number of shares outstanding is given. So if we divide that by number of shares given, right, by number of shares outstanding, comes to 1576. Okay. Okay. I should probably say S0. Right. So this is, free cash flow model, which is our, but it's just one of the many examples. I mean, it's not always like this because it depends on how the example is phrased or worded. Okay. In other words, I'm going to give you so another example. We don't have time to go over another example, but just to show you what example was given in actually in spreadsheet. Okay, so you can go to spreadsheet 13-2. Now, this example is more complex, way more complex, but my main lecture talks about this. Go to my main lecture and study this. I explain step by step everything. Why these look. Actually, it looks like this, but they are from here, right? None of these. We have some are given, some are not given, some are. As you can see, these are given, but this is a forecast, right? So please, watch my video and please try to emulate or try this out. What I did, in the video. So then, so basically, we worked with free cash flow to the firm, but then there is also free cash flow to the equity holders. And what's the difference between the two? Free cash flow to the equity holders is free cash flow to the firm minus interest payment times 1 minus tax rate. So in other words, free cash flow to the firm was free cash flow to the firm had where did I put it? Maybe I didn't write it here, but so here then. Operating cash flow minus investment in operating capital, right? But what was this? This was EBIT minus taxes plus depreciation. Now think about it. If it was just EBIT minus taxes, then it would be called EBT. I mean, EBIT minus interest. If it is EBIT minus interest, it would be called EBT. But this is EBIT minus taxes. So what should it be called? What can it be called? I mean, for lack of better term, but this is weird. But for lack of better term, I would call it EBI, because there's no better term. There's no EBI, right? But then, this cannot be, I mean, taxes can be subtracted only from EBT. You cannot subtract taxes from EBI, right? But anyway, for lack of better term, this is, so you have to make sure that you quote me correctly, because sometimes people don't hear me, people don't pay attention to every detail, and then they just think, I mean, they just say something out of their own impression, not of complete understanding. I never said EBI is the correct term. I said there's no better term. There's no because so for lack of better term, only because there's no correct way of saying it, I will just tentatively call it EBI. So EBI is not the official jargon, right? So interest is available. So basically, interest is a cash flow available to the firm, right? But not to the shareholders, right? Not to the shareholders. Of course, the company must also pay interest, but then sometimes if they are really stripped of cash, they are completely stripped of cash, then they will have to grab on everything, right? Even they will have to grab even a penny. And if that is such a dire situation, then but tax you cannot as long as you have income to pay taxes, then you should. Otherwise, you go to jail, right? You serve time for tax evasion. But paying interest can be deferred. Of course, the creditors will raise eyebrow, right? Nobody will like it. But if the company is dying, right? Please, give us a little leeway. We may not be able to pay you interest this time, but we'll pay you all the interest in arrears plus penalty interest next time, right? So it's cash flow available to the firm, but not to the shareholders, right? That's why you have to subtract the interest payment from there, and then there's of course there's always tax shield to the interest. Effectively, you pay only 1 minus tax rate times the interest, right? I mean, that's the interest you effectively pay. And then there's a change in net debt. What does that mean? Yeah, think about it. If you borrowed more, if you sold more bonds, right? There's cash inflow. If there's cash inflow, right? If there's cash inflow, then you have more cash flow. So that's change in net debt. It could go down as well if the so that's the cash flow to the equity holders. So this is why do we? This is an interesting thing because it's an alternate method. We can find the common stock value. We can find the common stock value, price of the intrinsic value of the common stock, even when we don't know, right? value of debt and value of preferred stock. Okay. So then if this is the case, then, value of the equity using, free cash flow to the equity holders, then we use, the golden growth model, right? This is, value of equity equity only at time t. At time t, this means, at time t, time zero, right? Value of equity only. So then using golden growth model, right? We can find value of equity at time t, and then of course we need to know the number of shares, right? Number of shares, it should be known, and then we divide it by number of shares. Then it will give you exactly the value per share, right? Price per share, right? So this in this example, right? Spreadsheet 13.2. It will ask for value, free cash flow. It's gonna, you're gonna have to deal with both value of, free cash flow available to the firm, free cash flow available to the equity holders, right? So that's 13.2, right? Please, do that. Where else? And then now that brings us to the price earnings ratio, right? Price earnings ratio is a it has also something to do with the present value of growth opportunity, but basically price earnings ratio is what they used before, before the age of discounted cash flow model, before the age of, right? In other words, before the age of dividend discount model. And actually, all these, models, actually, discounted cash flow models, they were actually, developed in the 50s, 1950s. Prior to 1950s, they didn't have these mathematical models. But what did they use? Price earnings ratio model. So price earnings ratio model is actually, if you think about it, this is what market price. Because in those days, they probably had the concept of fair value or intrinsic value, but they just didn't know how to calculate fair value or intrinsic value or rational price. But what they could do was, what they did was, price earnings ratio is market price over earnings per share. But don't you remember, previously, I'm sure we talked about not price earnings ratio, but you remember we talked about okay, I think we did. Do you remember? earnings per share over price. Earnings per share over price. And what is that called? Do you remember that? Do you remember? Anyone? Now, what's the dividend? What's dividend? Okay, we talked about it. We talked about it. Earnings per share over price is called earnings yield, right? It came up because dividend over price is called what? Dividend yield, right? Dividend over price is called dividend yield. That's too big. And also I talked about current yield too, right? Annual coupon divided by price of the bond, that's called current yield, right? Yield is, and I've been telling you from 100, Finance 100, I've been telling you over and over, yield is just another way of saying annualized return, right? So if you divide it by, because price at time zero is basically your initial investment. That's the price you pay. So whatever, dividend divided by that should be called dividend return. That's dividend return or dividend yield. And the earnings per share divided by the price should be called earnings return or earnings yield. And think about it. Earnings yield is a true I was telling you, earnings yield is a true measure of the earnings power of the stock, right? Because earnings per share is net profit divided by number of shares. Earnings per share is literally EAT divided by number of shares. So the higher this number, I mean, isn't it obvious? The higher this number, higher this earnings yield or earnings price ratio. You can call it earnings yield or earnings price ratio. The higher this ratio, the more earnings power that stock has, the more earnings power, right? But then what is price earnings ratio then? Price earnings ratio is simply the reciprocal of earnings yield. It's the reciprocal of earnings yield, right? Isn't that right? If you take the reciprocal, in other words, if you flip it, if you flip it, right? If you take the reciprocal, then it's price earnings ratio, right? And here's the thing. I said the higher this number, the better it is. The stock has, more earnings power. But on the other hand, so that means, if the lower, if this is higher, it should be lower. Yeah. Low price earnings ratio means, stock with, a lot of earnings power. However, they want, they say high price earnings ratio has a lot of present value of growth opportunity, right? That means high price earnings ratio has a lot of growth potential. So this is at first this doesn't this seems like a conflicting argument. These two are seem like conflicting argument, but not really. So we're gonna talk about that after the break. It's a good time to take a break. So 11:30. So we'll reconvene at 11:40. Okay. All righty. Let's take a 10-minute. All right, we're back. We're back. So, excuse me. So, getting back to what we were talking about. So, this looks, probably, you might wonder, what is this all about? Again, so this all has to do with, the connection between the price earnings ratio and the present value of growth opportunity. Again, I said, think about it. By any common sense, by any logic, right? The higher this number, right? The higher the earnings price ratio or earnings yield. That's a more profitable stock. It goes without saying. And if this number is high, then this will have the reciprocal will have to be low. But then, even in finance, right? I mean, in academia, there are two schools, one or two camps. One camp or one school favoring or championing high earnings price ratio, or that means low price earnings ratio, right? And the other camp championing the high price earnings ratio. And actually, the low price earnings ratio, champion of low price earnings ratio or high earnings yield is no other than, Warren Buffett. Okay. It's a well-known fact that Warren Buffett's investment strategy is basically value investing. What's a value investing? Finding stock that's undervalued. If the stock is undervalued, that means price is low for its earnings, right? Think about it. This stock pays $20, let's say $20 earnings. I mean, let's say two stocks paying $20 earnings, but it price is $100. Right? This ratio is 1/5, right? Or 20%, right? But think about it. If you pay $100 and you get 20% return, of course, earnings per share isn't directly distributed to you, right? No, I've been telling you, no company distributes the earnings directly, and growth firms pays nothing. And if they ever distribute something, that's dividend, right? But it's a very high. On the other hand, another company pays $5 earnings per share. Its earnings per share is $5, but it's $25. Price is $25. Basically, their earnings yield is the same. This company or this company, right? Company X, they are like, company X prime. They are like, just, more, the price is more expensive, but earnings power is the same, right? So actually, doesn't matter, right? Whether you buy this company or buy this company doesn't matter. right? Your return will be the same. I mean, with $100, you can buy only one share, but with $100, you can buy 4 shares. With 4 shares, and $5 earnings per share, still that's going to be, with 4 shares, $20. On the other hand, suppose we have a company like, $20 earnings per share. The price is $2,000, $1,000, let's say. Price is $1,000, right? Then what's this, earnings per share? Earnings per share is, 1/50, isn't that right? Or 2%. Not a very good, you might obviously compare, pound per pound, dollar per dollar, right? You would prefer this company. And you can also tell the price is too expensive for its earnings power. Isn't that right? Price is too expensive for its earnings power. And it's just like you buy a $50 stock that pays $1 earnings per share, the same thing. Right? Call this company Y prime. They're same, right? Still the same thing. So you would say, I'm not gonna go for this. I'm gonna go for this, right? But then here's the also you can this is earnings yield, but if you flip the number, if you do the price earnings ratio, right? The price earnings ratio of company Y, price earnings ratio is 50, whereas in company X, price earnings ratio is only 5. Okay, so now that makes sense why Warren Buffett champions this strategy, valuation, value stock, right? His his strategy is value stock, and for its earnings power, clearly price is undervalued, and in this case, for its earnings power, price is overvalued, right? But then think about it. If you can find a stock like this, if you can find something like this, right? If you can find a stock like this, what would you do? Of course, everybody will run to buy these stocks. But when massive number of investors run to buy this stock, what's going to happen to the price?
It's going to go up.
Yeah, it has to go up, right? It has to go up. Strong demand will push up the price. If the price is pushed up, then what's going to happen? Eventually, it's only a matter of time that even this stock turns into this kind of stock. The price will be, right? So the window of opportunity isn't open for very long. The window of opportunity, the window is very limited, right? The window, during which the time during which the window is open is very limited. And if you are the first runner, right, first comer, then you can make profit by buying this at this price. But when the price goes up like this, then you sell. You realize profit. But if you're at the tail end, you don't, and that explains why sometimes, and you see outrageous price earnings ratio. Not 50 is not outrageous. Actually, outrageous price earnings ratios are something like what am I doing? Sometimes you see outrageous price earnings ratio like 200 or even more. Tesla used to be an example of outrageous price earnings ratio. It was even almost infinity. And even when it was before Tesla made any profit, it still had price earnings ratio of something like 200. And then after it started to make profit, then still about 200. And then maybe price earnings ratio is like 100 or 150. So everyone knows the price earnings ratio is outrageous, but why is that ratio hold? Why does that ratio hold? It holds because such a high, it's overpriced. Clearly it's overpriced. Such a stock is overpriced, but that price earnings ratio is held, right? Because what explains that? The only explanation is because there's a strong demand. Strong demand, right, holds this price. Why the strong demand? The strong demand is due to present value of growth opportunity. In other words, present value of growth opportunity, growth potential. I mean, to put it another way. But then growth potential is actually, it's a, it can be growth potential. It can be just a hot, ballooning, right? It can be just a ballooning, or, in other words, empty. It can realize, this growth potential can realize, if it is so that's why fundamental analysis is important. Because it can be nothing but a hot ballooning, or it can be actually, Tesla, in case of Tesla, at least, it lived up to its growth potential. In case of Tesla, it turned out to be positive, right? But then, something like what was that? WeWork, or was it WeWork? After IPO, there was a lot of growth potential. It can turn into just nothing but hot air, or it can really turn into a solid return. So how do we tell? How do we know if we have to look into I need to look into the so one if we look into PEG ratio, it can tell us whether it's got a solid basis, or whether it's just a hot air balloon, right? So I'm gonna get to PEG ratio a little later, but then I want to talk more about the theoretical basis for present value of growth opportunity. And we all know, I mean, so to understand, before, all this math, we know, price is basically, P0 is not the right, I want to avoid, P0, but then, as I said, V0 is a better, because V means, intrinsic value, right? But then this sounds like a aggregate, common equity value. But, so sometimes I use, sometimes I use S0, right, to represent per share price, per share stock price, because V0 looks like, aggregate. It doesn't matter whether, and even if it is P0, it doesn't matter, because, intrinsic value will be equal to market price in equilibrium. Of course, equilibrium doesn't, happen easily, but we all know it is, using, golden growth model. I mean, golden growth model is basically, R minus G, right? And then you also know, we can, instead of R, we can use K, because K means, K is cost of equity, right? Which is, required return, right? And then we also know that, we can rewrite this as earnings per share at time 1, right? Times 1 minus plowback ratio over K minus. What is growth rate? Growth rate is return on equity times plowback ratio, right? So in other words, they don't pay out a dividend. They pay out only dividend. They don't pay out earnings per share. If they pay out earnings per share, then the company has actually zero growth, right? So in other words, we can also rewrite. I mean, prior to that, so earnings per share 1 times dividend payout ratio, right? That's dividend payout ratio. And dividend payout ratio is 1 minus plowback ratio, right? And think about it. If and then, because this is, the left-hand side is P, right? P0. If you multiply, I mean, if you divide both sides by, earnings per share, right? It's the same thing, right? If you divide, so I divide both sides by earnings per share. Then what happens? Of course, these two will cancel out, right? So you come to then, then PE rate, then PE ratio can be 1 minus B over K minus, what did I do? This was unnecessary. That's already G, but what did I do here? Sometimes I do silly things like this, right? Because this thing is G. Give me a break. ROE times B, right? So P ratio can be rewritten this way, right? Now, again, I started out by saying that the P ratio was used before the age of, dividend discount model. Yeah, so prior to like 1950s, right? The way they measured estimated stock price was basically using P ratio, because by definition, think about it. By definition, because it's price over earnings per share. If you multiply it by earnings per share, it should give you price. Isn't that right? Mathematically, no, because they cancel out. But then this is you might think this is was someone saying something? But this is a stupid thing. You might think, this is a very silly thing. Why? Because earnings per share cancels out, you get back the market price. I mean, if this is market price, this is again market price. I mean, what's the point of doing this? Yeah, if it gives you back the market price, there's no point in doing this. But and the reason they were doing this is because in the old days, when they didn't have DDM, they needed something to find something to estimate the intrinsic value. But this way, they cannot do intrinsic value. So what was the idea? The point is, this price earnings ratio is the industry average. This is the price earnings ratio of the industry. Okay, and then this earnings per share is earnings per share of the company X or company A, and then company X, right? So this is the that way you can find the intrinsic value of company X, company A. So you will find the intrinsic value of company X. So this was rather a kind of rule of thumb. Why? If the price earnings ratio of the industry, if the average is 20, right? If the average is 20 and the earnings per share of this company was $5 per share, then through the lens of the industry, I mean, an average company in this industry would, if the on average, if the company X has $5 earnings per share, then the price will be, it's rational to have, a $100 price, right? In other words, through the lens of the industry, right? Through the so this was in a way, yeah, on average, this industry's price earnings ratio is 20. So yeah, this will, this should be. So then, you can tell if the P of X, market price, if the market price of this company X is, let's say, $90, then you can say, oh, this company is undervalued because this is what it should be, right? This is what it should be, but it is currently $90 in the market, so it's undervalued. Then this is a buy target on any undervalued, because this is priced cheaper than what it really is. Or on the other hand, if the market price of this is 110, then this is currently overvalued. If it is overvalued, sooner or later there will be a correction, right? Price correction. Of course, this is also correction. I mean, from if the market price is 990, and then it should go up. I mean, because intrinsic value is 100. Intrinsically, it is worth 100. So anybody who understands this mechanism, then they will know there will be an upward correction. But and if this is the case, there will be a downward correction. And so correction can be either upward or downward, but most of the times what people they only consider, they call downward correction. They are actually talking about, they refer to downward correction, right? They are using the term usually for downward correction. So this was the reason price earnings ratio was mainly sought. Mainly why it was mainly sought for. But again, if you understand this, also if you understand this, and in this case, it is the price earnings ratio of its own, your own company, price earnings ratio of your own company. You can find price earnings ratio of your own company. In other words, you can find price earnings ratio by the market, right? By the market price with the market, but you can find the rational price earnings ratio, because it is basically the relationship between plowback ratio and the growth rate, right? So if you know what should be the correct price earnings ratio, I mean, using the market price, yeah, that's price earnings ratio. Normally, market price divided by earnings per share, but that doesn't give you intrinsic. I mean, the price earnings ratio of the intrinsic value, but this way, and then. So now we understand why it is like this, and then. So I'm kind of working backward. So that's the price earnings ratio, right? And then because it's 1 over k, we have 1 over k, right? If we factor out 1 over k, right? So from this, now it's a little bit. Suppose plowback ratio is 0, right? Suppose plowback ratio is 0. So you're not paying anything. You're not paying anything as dividend. And if the plowback ratio is 0, then the price will, everything. So the numerator will be just earnings per share, right? And the in the denominator is going to be just K, because plowback ratio is 0. Now mathematically, again, think about it. It's going to be if plowback ratio is 0, right? Now think about it. This thing is 0, so the whole numerator will be just earnings per share. This is 0, so the whole thing will be 0. In other words, growth rate, that means growth rate is 0, right? Growth rate is 0, so the price will be simply then, earnings per share over K. Okay, but then this is this will be less than, this will be a smaller number than, first of all, this will be a smaller number than the regular case. In other words, this will be a smaller number than dividend at time 1 minus K minus over K minus G. Why? First of all, always the fraction is, mathematically, the fraction is a matter of what is, even if you have the same dividend, if the numerator is constant, if the denominator goes down, the whole fraction will go up. And the denominator will go down if there is a G, right? Because K minus G will be smaller than K, right? And you might also wonder, is dividend, wouldn't earnings per share greater than dividend? Yeah, but whether this is greater than this, and whether how big, which one dominates, right? And I would which one dominates? because actually in stock, the difference between earnings per share and dividend, that cannot dominate this effect. In other words, this effect dominates this, right? The difference, the K minus G being greater than K, that dominates this, right? Earnings per share being greater than dividend. So eventually, that's why earnings per paying out all the dividends, paying out all the earnings as dividend, right, is going to result in a total disaster, because once this happens, then there is no present value of growth opportunity is zero. I mean, first of all, if this is zero, right? If this is zero, right, there is no growth, right? So this slide is basically this slide is, mathematically proving, that relationship. Now, so the rest of it, I was talking about PEG ratio, but we didn't have time. So I guess we'll still need one more session on this. But again, the main lectures have covered already everything. So all you need to do is just, go over the main lectures if you haven't yet. And it's always, imperative that you stay ahead of the game. Stay ahead of the game. If you don't stay ahead of the game, you will always fall behind. Not just, behind the rest of the class, but you are behind the exam, right? So make sure that you, my YouTube channel, right? So it's imperative to go over that before you take the exam. Okay. All right. So that's all the time we have. Any questions so far? Any questions? Any questions? No? Any questions? No? All right. If you don't have any questions, we'll have to call it a day. Have a great day, everyone. And good luck with your first midterm. And I will.
Professor, I have a question. The midterm.
Yeah. Okay, hold it there.
Okay.
Let me stop first. Let me because I said I dismissed the class. Let me stop.